Another regional bank collapses. First Republic Bank of San Francisco fails, and then rules are bent so that JP Morgan can acquire it. I've got those details and how they impact you. That and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Guys, the regional banking crisis is not over, apparently, and I sort of suspected this. No one knows the future, but the reasons that led to the first three banking collapses back in early March, those conditions still exist. In fact, they're not going to be able to pivot and ease up quickly at all. And so we had the First Republic Bank of San Francisco essentially coordinated some sort of deal by regulators to fail and simultaneously have a bunch of assets purchased by JP Morgan Bank. We're going to get into some of those details in just a second, but let's first talk about the why, okay? Because a big question, which we're going to get to, is how does this impact you? But the really big question is, when is this going to be done? All right, so let's get into the timeline before we get into the conditions and the why. On Wednesday, March 8th, we had Silvergate Bank essentially collapsed, essentially failed. They're still working on an asset sale and so on. So that was Wednesday. On Friday, March 10th, it was Silicon Valley Bank that fell under FDIC receivership. And then on Sunday, Signature Valley Bank also went under FDIC receivership, wouldn't even let them open, wouldn't even get to the market open on Monday. So all three of those had some similar characteristics. You could look and say there's some mismanagement and there was some excess risk taken. There was some friendliness into cryptocurrencies, and not that they were speculating in that, but they were lending and doing banking with businesses that were heavily into the crypto industry. And as that area was weakened last year and over the past 6 months, so that impacted their business. And then Silicon Valley obviously was the tech-friendly bank, and as tech layoffs and as that industry has been consolidating, things obviously with the bank that caused some issues. And so there was this question after those three all fell within a short period of time is it now contained, or will there be more? Were the ancillary issues, or were the similarities between these three banks, does that mean that it's really going to be isolated to these three, or will it spread to others? And while I would say there were contributing factors with all three, the why is more of a condition that doesn't solve itself quickly and actually impacts a lot of other banks. So here's how it works. When you put your money in your bank account, savings account, checking account, whatever, while it looks like and feels like that money is just sitting there at the bank waiting for you, the bank actually is using your money and they're making money on it. That's how the financial system operates. And so they're taking that money and loaning it out to others and earning an interest rate. Now, if there's enough people buying cars or mortgages or whatever, they're taking your money, they're loaning it for those reasons. They're charging, say, 6% on a car loan, and they're able to pay you a competitive interest rate, a couple percent, something like that, and then the bank makes the difference and so on. But when there aren't as many loans out there, or they've got a lot of deposits, then a lot of banks will actually lend your deposits, lend that money to the federal government. The federal government obviously running a deficit, they're borrowing tons of money, so they can always loan the money to the federal government. They do that by buying bonds, okay? And so these banks, and I'm going to say surprisingly, although I'm not a banker myself, but as we invest people's dollars, we've been very cautious about investing in long-term bonds. My entire career, the thinking was interest rates are very low. At some point, they'll go back up. You don't want to own long-term bonds and really have locked in, current low interest rates for a long period of time. That's what these banks, apparently, a lot of them did. They invested, they lent money to the government by buying 20 or 30-year bonds, locking in historically low interest rates, and getting that interest rate, receiving that interest over 20 years before they get their money back, or 30 years before they get their money back. So what that meant is these banks now were only earning 1 or 2% on a large chunk of dollars. And as the Federal Reserve needed to raise interest rates to compete with inflation, as they needed to raise interest rates very, very quickly, all of a sudden these banks needed to pay their consumers, or their customers, a more competitive interest rate, 2%, 3%, now 4% interest, but they couldn't afford to do so because all of their investments were still only paying 1 or 2%. So they couldn't. That's why your bank account, your savings account, is still probably paying point nothing, because these banks can't afford to do that. Interest rates rose so quickly in the short term that their current loans that are on the books, the lending that they've done, they're not earning a better interest rate on that. But then the second thing that happened was, as interest rates rose, bond investments dropped in value, just like your bond investments that you own in your portfolio. So these banks now had all of these investments, these bonds that they'd purchased, this money that they'd lent, that's now worth less because interest rates skyrocketed. And as depositors said, we are pulling money out, or if you're a tech startup and said, listen, I had this money held with you, I need to withdraw this money because our business is falling on tough times, or you're not paying me a competitive interest rate, I can go to an online money market and get a competitive interest rate, I'm pulling my money out. These banks eventually were forced to sell these longer term bonds, basically that they'd lent the money out, they need to get the money back, they sell them at a lower value because they're worth less because interest rates are low, and all of a sudden that shows weakness. The bank needs to raise capital, and very quickly things can spread. So that's all the why. That's all the why. That's not just unique to Signature Bank, Silicon Valley, and Silvergate. That's a lot of regional banks or smaller banks, and that's why this regional banking crisis has been coined. First Republic Bank, as well as a whole host of others, you've seen their stock be extremely volatile on Wall Street as folks have looked and said, they're risky as well. There's not a lot of strength there as well. Fast forward to this past week, it looks as though regulars essentially auctioned off. They were courting banks and looking for bids to say, look, it's about time that we're going to need to take over and seize First Republic Bank, and we'd like to coordinate a deal with a bank that can come in and purchase. And so if you take a look at this tweet, this sort of sums it up. Rules were bent in order for JP Morgan to acquire First Republic Bank. There was some coordinating with the JP Morgan was going to pay FDIC a certain chunk of money. They were then going to get a loan from the FDIC for an even larger chunk of money. Because JP Morgan has more than 10% of all deposits out there, they're not allowed to make this acquisition. That was completely ignored as well. A lot of the rules were bent in order to make this happen, but if this didn't happen, then it was going to show the public or communicate to the public that not only did another bank fail, but there might be even more, bank weakness versus, well, this failed, but listen, JP Morgan swallowed it up. All right, so that's a little bit of the history and the why and what happened in this very, very unique situation. The question remains, will we see more of this? And guys, I think it's entirely possible. And if you look at Wall Street, there's a lot of other regional banks that are seeing their share prices plummet. And I think it's entirely possible because of the conditions that we're in. The conditions where the Federal Reserve is still raising rates or needs to keep rates high, okay, that is going to be there for several months, if not another year, in my opinion. I don't see interest rates dropping like a rock. If we see a recession, which I'm going to get to in just a second, we might see interest rates come down. That will help ease some of this pressure. I just don't think this problem solves itself quickly, and therefore, how many banks are just trying to hang on a razor thin edge there? And I don't think we're past this. So what does this mean for you? Number one, you've got to manage your FDIC limits. Does this mean that the entire banking system is on the fringe? I don't think so. Personally, I don't think so. But it does mean you should be careful with how much you have in deposits. And if you're anywhere close to the FDIC limit, make sure you stay below that. That's number one. That's the first thing that I would do. Second, because banks are, on the edge, I would look for tighter lending standards or more borrowing restrictions. So if you're looking for an auto loan, a home loan, something like that, I would expect that things are going to there's going to be more scrutiny for that. And so be prepared for that if you're going to be a borrower. If you're going to be a lender, meaning you yourself are going to put more money in savings or so on, be looking at, make sure that your savings accounts are FDIC insured, they're free, and make sure that they're liquid. I would be looking at online money markets and those sorts of things that have those features, but are offering a more competitive interest rates than some of these local or regional banks. And then the final thing that I would have you apply from this is be watchful for an overall weaker economy. Tighter regulatory or lending restrictions or borrowing if you're a borrower, that is one of the signs that leads to a less economic activity and a potential recession. When we've got regional banks, the big question mark over those, we've got interest rates rising, all of that is sort of potentially contributing to a slowing economy. I think then greater risk of potential recession. We've certainly still have hot spots in the economy, but we also have areas that are slowing down. To me, the longer that the conditions exist where regional banks could be feeling this pressure and more potentially fail, I think gives even a greater chance of an upcoming recession. Done lots of videos on how you can prepare for a recession, but I think that's sort of the third takeaway with this is make sure that you're bracing yourself, preparing yourself for a potential recession or more financial challenges. One of the ways that you do that is working with your CFP, looking at all 6 areas of your financial life, seeing what adjustments you can make, how you manage risk, how you manage your present financial position, what adjustments you need to make in your investments to ensure that you're not taking too much risk and that you're on track with your plan. So work with your certified financial planner on that. If you don't have a CFP, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us here as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.